Welcome, everyone, to the last Not Your Average Investor show of the year. Sparkle, 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 sparkle. Today, we are diving into your biggest questions. We're talking about what are the rates? What's the inventory like? What's the cash flow situation like? But most importantly and most interesting to me is there's been two fundamental changes in buyer behavior for the Jacksonville Not Your Average Investor, and I'm really pumped to get into it. I'm your host, Pablo Gonzalez. With me today, returning to the show, man, the ultimate utility player of any team, the Swiss Army knife that can do everything and do everything well, founding member of the show and the community, my good buddy, Kate Sutherland.
Hello.
Welcome to the show, buddy.
Thank you.
Yeah.
I was wondering what the nickname of choice would be today.
What was the nickname last time?
I don't think there was one.
I don't think there was one. I don't think
it's just a very heartfelt introduction.
It is.
Not necessarily a nickname.
Because it comes from the heart.
Yeah.
And it's felt.
Yeah. I feel it. Baby.
And do you see us off? I think he's skiing somewhere, right?
I don't know.
What it is?
I don't know. I've lost track of him.
Such a mystery. Such a mystery. Anyways, we're wishing him a happy new year. And of course, we are welcoming our community with our tradition like none other, which is called what, Kate?
The roll call.
We got the mystery man checking in from Kuwait with a happy new year.
Happy New Year.
Do you want to say the names? Do you know all the nicknames? You don't know.
Nope.
Danny Davies is our mystery man. We got Joanna, our community manager. She's in the Philippines. They already celebrated New Year, so she's hanging out post New Year celebration. Joanna,
She's ahead of the
good to
game.
have you here. We got T. Caster from Nashville, Tennessee. Good to have you, T. We got our usual leadoff hitter batting fourth today, John Henning. We got the ringmaster joining us on this New Year's Eve, Drew Barnhill. We got the maven from the mountains of Denver today in Snowy Vale. I'm not jealous at all. Leslie Wilson, good to have you. We got Jeff Pettyjohn welcoming us with a happy new year. Ed Lowry with a happy new year from Jacksonville. Chris Lee from Fernandina Beach. Good to have you. Our regulars, Gary and Rosalind Riley from Murrieta, California. We regard you highly.
They reached out to me just recently too.
Yeah?
I'm interrupting your roll call,
Please.
but it was just so sweet to just see their names come across my inbox. So and now they're here.
Oh, and now here we are,
And now
all
we're
of us
here.
together on a New Year's
Love
Eve.
them.
Who else we got in here? We got Mary Rockin from, she's in Arizona, right? Mary, you're in Arizona? Yeah, pretty sure.
But she's rocking.
The
wherever
Shaw man. The Shaw man is in the house with his traditional good morning, good afternoon. Nadeem Shaw from the Pacific Northwest, the fairy godmother of the Not Your Average Investor Show community. You know,
Hi, Jen.
Jen fills in, the sweetest. Good to have you in here, Jen. Sir Jeffrey Bolton, wishing us a happy end of 2024. Good to have you. The guy who's Rockland, the number 2 Steelers fan of the Not Your Average Investor community, Lewis Hudnall, in the
Should I
house.
tell him that my husband is from Maryland and is a big Ravens fan, or should we save that?
I don't think you should have brought that up at all. Okay, that's pretty awkward. What next? Are you going to talk about how great Cleveland is? All right, we got Leo for rocking on. Leo, always happy to have you back, man, because we love singing your voice, your name, and I guess your work schedule has kind of made it so you can't. Our favorite name to pronounce, Aaron O'Neill. Into the lights. Aaron, good to have you checking in. John Williams checking in from Uniondale, New York. John Williams is a legendary musical score composer.
Wow.
Or at least he shares the name with him.
Okay.
And I like to poke him about it. Good to have you, John. Who else we got in here? We got T is in the house. All right. Oh, the first family of the Not Your Average Investor Show. Ken and Carolyn Meline. We salute you. Joe Culler from South Carolina. Joe, good to have you, bud. Who else in here? Charity Graham is back in the house. Charity, good to have you checking in. Le Monsieur Reggie Vonze from the Indian Empire with a happy new year. Reggie, good to have you, buddy. Always like to practice my French accent. Matt Coffey from Orange Park, right down the street here. Tom Banzer from Angola, New York. Angola, isn't that an island in the Caribbean as well? Probably same as New York.
Yep.
Same. Oh, favorite smile from the Pacific Northwest, Pamela Myers, your friend. Yeah, that's right. Just talked to her. Early bird Dean Curry checking in a little late today. No big deal, Dean. We're not keeping track here, but you're welcome. Who else we got out here? Lewis Hudall wants to say boo Ravens.
Oh, no. It's okay.
All right, cool. We are through. Ooh, Justine Herrera checking in also with a happy New Year's. All right.
Happy New Year.
Let's get into it, Kate.
Let's do it.
We are wrapping up 2024.
Crazy.
I'm really pumped to tap into these trends of what like new investors are coming to the market with that we have uncovered in preparation for this show. But for right now, let's give the people kind of what they came for, right? Like what's the current snapshot when you're on a sales call I imagine it kind of like starts with rate because the rate kind of like determines the decision, which goes into pricing, which goes into cash flow.
Yep.
Is that kind of like the bridge that people are walking these days?
It is. It is. There's so many conversations too that start with cash flow. And by no means are we tiptoeing around that conversation, but I think this year we've probably had more folks than any coming to us understanding the dynamic that go into cash flow, right? It is so much more than just the property itself. The rates are a huge component of what dictates your cash flow from each property to property. And with that, I think everybody kind of didn't know this year? Are we starting to see drops? Are we going to wait by the end of the year and then maybe rates are going to drop? Are they going to go up? Like, we've battled this for, it feels like 2 years now of this kind of roller coaster of what rates are going to do. And they've largely been pretty consistent this year. And that has allowed us on our side to say, okay, with rates at least a relatively stable position, and when you compare them to historic rates, we aren't astronomically high.
True.
Are we as historically low as we were? No. Do we want to be back to that place? Arguably not, right? But it has allowed us to kind of look at our inventory and say, okay, what levers do we have to pull here? And that's where we've started to be able to look at things like buying down your interest rate. That was really not a conversation that we had with clients coming into the sales onboarding process prior to this year. So you look at that opportunity, you look at some of the incentives that we've had on there, but you know what? One thing that has continued to do is prices have still continued to go up on our inventory. So I just think it's amazing. We've had John Siebert on the show before. We've got some great networks with our lender base that we utilize. And this morning I could email John and say, hey, going on the show today, what are rates looking like as of today? Because they will change and they are changing every single day. So knowing what they are right now with, the relationships that we have with the point buy down aspect, we can confidently say you're looking at about a 5.5% interest rate.
Okay.
But a couple weeks ago, that was 5.25%. And a little bit before that, that was 6%. So there is still a lot of fluctuation, but at least we've kind of been in a pretty similar ballpark. And just having that ability to say, hey, what are they today? So we can try to give you the best, most accurate depiction of what it's going to look like at the time you actually lock into your rate is invaluable.
Got it. So what I'm understanding from what you just said is people are really starting to like come to JWB with a much bigger picture understanding of kind of like what drives the short-term performance of the
Correct.
investments.
Yep.
And we're going to talk a little bit more about that perspective that people are coming to in a little bit. And within that is rates, right? Like the dynamic between rates and prices are big. Rates have been not necessarily volatile, but not stagnant, but they've stayed kind of like in this window of like mid fives, sort of, right? Like low to mid to high fives kind of thing. And that's a constant conversation that you are having with the JWB Preferred Lender Network. For example, John Siebert, who we've had on the show, texted him 5 minutes ago. He told you right now they're at like 5.5.
Yeah.
Right.
Yeah. And I mean, kind of speaking of the levers pull too, we mentioned you've got the ability to buy down your rate and you can put points towards that. It's also down payment, right? I mean, for a long time, it was just kind of a standard for us to say, 25% down is the standard. Can you go lower? Absolutely. Could you go higher? Absolutely. Well, this year, when you look at the rates and you look at prices and you are trying to stay at that break-even cash flow as best as you can, working with those factors like the prices and the rates, 30% down is very, very common now for our clients where, we have the tool to showcase the impact of this property at this purchase price with this rent amount coming in. How can we manipulate an interest rate and customize it to what your situation is or what, the lender is saying rates are as of today? And then how can we manipulate the down payment percentage so that we can really build and customize the plan to exactly what you need, which a lot of people are still very, very, very much of the mindset that says, hey, I don't want a liability. I don't want something that I'm going to have to walk into and just sink a bunch of money in. But I also know that I'm willing to let this thing do what it does best, which is be my little crock pot and cook in the background. And you set it and forget it. And that has allowed us to say, okay, how can we kind of build this plan to get you into a break-even cash flow perspective with a 5.5% interest rate, let's look at 30% down. What does that do to your entry point, your capital? What do we need to be able to hit that? And then we go from there.
I love the crock pot analogy.
Oh, yeah.
Right? 'Cause
I've used that. If you've been on the phone with me recently, you've heard me say,
Yeah.
let's be your crock pot.
Let this be your crock pot. I love it because I think of my crock pot. It's just like I do a little bit of preparation.
Yep.
I throw it in there, and in the morning, my house smells delicious, and I have lunch for the next 7
Right?
days.
You come home and you're like, thank you.
I love that. That's cool. All right. So recap. Rates are doing what they're doing. That means that folks are able to in the mid fives, right? I think
Yeah.
Lowry said here he just closed and he was at like a 5.65, something
Yep.
like that. Mid-January closing, locked it in 5.62, closing mid-January. Yeah, that checks out.
Yep.
And then now what you're talking about is based on the pricing and based on kind of folks' plans and the crockpot recipe that they're trying to cook, whether it's chili or al pastor, you're seeing a lot of folks put 30%
Yeah.
down these days. Maybe 2 years ago, it was like a no-brainer, 25%. When I first started, it was like 20%
Yeah.
worked as well. We then had another blip that was like 25% was back in the mix.
Yep.
But you're seeing mostly people put in 30% down right now.
That's what we see. Yep.
So let's reverse engineer that to kind of like where the pricing is so folks can understand how much they need to bring to the table for an investment like this. Where's pricing at these days?
Yeah, it's a great question. So, and two parters, right? So you've got kind of your minimum capital that you think you'd want to have really ready to be able to deploy. So much of my inventory right now, historically, I've always said, we're about a 60-40 split, a 70-30 split of new construction and renovated properties. You look at the market as a whole too, as to what we would have to be able to find and acquire to buy a property, renovate it, be able to turn it over and sell it, rent it to make the numbers work on the back end. That's been a lot more rare. So this inventory that we have right now is very heavily weighted. As of today, I have one renovated property available for sale.
Okay.
Will more of them come online mid Q1 next year? Yes. But as of right now, everything but one is new construction. So I say that because our renovated properties, those are usually your entry at a lower price point, right? Which is fantastic to add to your portfolio with those. But for now, mostly new construction prices are probably $215 to $280. And we have a duplex, which we almost never have duplexes for sale.
Both sides of the duplex.
Yeah, you're buying the
full
building.
duplex.
So you've got
Very
two
cool.
sides, both sides are already rented, and that's $585
Okay.
for purchase price, which
So
you think
580
divided
is
by
like
two.
about 290 per. No, 580. Yes. Public math. Never do
Yes,
public
you
math on air.
do. No,
Yeah.
into your eyes.
Yeah.
You come up with the answer.
Yeah, it is.
Yeah.
Yeah.
Sure.
Yeah, it's 290%.
Yeah.
Okay, interesting. All right, so low to mid 200s for new construction. Is the duplex new construction?
Yes.
Oh, interesting.
Yeah,
Very
it
cool.
is.
Very cool. And then there's only one renovated property right now. You know, as you're saying this, I was actually prepping for next week's show,
Yeah.
perfect. Which is there's this report by Fannie Mae talking about like the 5 predictions for the year for next year. And one of the predictions, teaser, is that new construction is like the new darling of like inventory right now, right? Like, so that checks out.
It does. It does. I mean, and I always like to keep it in perspective too of the one renovated property, it's 180,000 entry point, right? So when you're building that portfolio, those properties, you think about the entry point that allows you to grow your portfolio. Those usually go very, very quick because especially our clients that know us and they know JWB and they're saying, I can get one at 180. Sign me up for as many as I can gobble up. So the new constructions, of course, are amazing opportunities as well. I think the perception of new construction always aids in this mindset of thinking, well, I'm not wanting the additional maintenance. I don't want additional vacancy. And it's pretty neat when we actually go and run the numbers. There's not one that really outperforms the other because of the standard at which we renovate our properties, which then in turn kind of goes back to, in order for us to be able to renovate at that high of a standard, the acquisition has to make a lot of sense. It's just been harder to do this year in this market.
Yeah. Okay. Interesting. The chat is happening, right? Communities talking. A couple folks talked about like the incentive package that's been going on. I know that there was an incentive package that was expiring at the end of this year.
Yeah.
But actually today.
Yeah.
Is that still available? Like
If you go
somebody,
under contract today, yeah,
so probably
it
not.
would have to be, yeah, it would have to, it would probably have to be somebody that has already been in conversations with us.
Okay.
Because it'd be really hard to start at square one today
Yeah.
and make you feel good because, you know, you always walk into from a business perspective. Obviously, we wanted to put our clients in a really wonderful spot to be able to lock into purchase prices today, but also for the team. Like we just want to come out swinging in Q1.
Yeah.
And so that was really the mindset behind the timing of this one. But at no point would I ever want to sacrifice how we onboard a client to just take advantage of an incentive.
Yeah.
If you start to bypass all of the steps of, hey, well, what is this going to look like for me as I actually become the owner of it? It gets pretty dangerous because now you're closing on a property and you're like, whoa, 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 are you also the property manager? What does that look like? And that's
Yeah.
not how we want to
Yeah.
onboard anybody. So
Totally. So that being said, Jeremy Bowen, I appreciate you popping in the Q&A, right? Like if you want a question asked on the show, put it in the Q&A because the chat does its thing and these glasses aren't real. So they don't actually help me see from far away. But that being said, so the incentive, what incentive package are you offering from Jeremy Bowen? We were just talking that there's still a maintenance credit that JWB is offering?
Yeah, so the December incentive aside, there's two. So if you have a 3-pack, if you have 3 properties that you're putting under contract at the same time, then that yields you the opportunity to get a purchase and sales incentive. So that's 2% of the purchase price that is applied on your contract at closing. So earlier we talked about your interest rate, right? We talked about that opportunity to buy down your interest rate. Well, it costs money, right? So in order to be able to have JWB contribute to that, 2% of your purchase price is similar to about 2 points that you could use to buy down the rate. So that helps you from a closing cost, less capital out of pocket at closing. But that's if you have 3 properties under contract simultaneously.
Okay, so if you're buying a bundle.
Correct. Oh, love it. Beyond that, so let's say, well, I've got the capital to be able to buy 1 or 2 properties. What you get there is a property management incentive that after you close on the property, you'll get your first statement through JWB, and that same 2% of your purchase price, you get back on your first statement. So you think about the impact, you know, kind of full circle here of where we started with rates, purchase prices, you know, by the time the impact that those have on your net rental income. The other thing to consider is any sort of maintenance or vacancy costs. So this was JWB saying, hey, we don't get to control rates, right? The market is still growing. It's still very healthy. So that's going to continue to have an impact on purchase prices going up. What can we do on the back end to make sure that you don't have these additional maintenance and vacancy costs come at you in the beginning? And so that's what that property management maintenance incentive is on the back end. So still 2% of your purchase price on your first statement. The idea and the goal behind that is this is capital for you to reserve so that you can utilize that for any additional maintenance vacancy that you'd experience in the first couple of years, if and when they come.
Okay. I'm going to ask you to repeat that to me one more time for 2 reasons. One, I told you I have a little bit of a sinus headache, and but I was also just pumped that Jeremy asked the question, and now he's saying thanks for he's a new guy. So Jeremy, just want to welcome you. Thank you for asking a question.
Absolutely.
It always takes a little bit of courage to like jump out in front of the community when you see such a thing. So 2% of the purchase price. So whatever the price of the property is, let's say $225. Since that's going to be really easy math for me.
It's in all of our properties, it's between about $4,000 to $6,000.
Okay, thank you. So, 2% of the purchase price, which will come out to between $4,000 to $6,000, is then credited back to you at the end of month 1 as a credit towards your future maintenance expenses.
Yeah, it's a line item on your first statement, right? So you've closed on the property, and then now you get your first statement. So you'll see like your first property management fees, rental income coming in, plus that 2% line item. You'll see that as a credit on that statement. That is just money back to you.
Okay, so that's money back to you. And that means I can take that money and, I'm just mentally thinking, all right, that's going to be money coming back to me. So now I can use my own money to buy down a rate or, and use it that way. Okay.
Yeah, if you end up, so let's say, you're not doing the 3-pack and you are wanting to take advantage of the opportunity to buy down your interest rate, then we already on our tool, we can account for that and what you'd expect in terms of your closing costs, estimate as close as we can. And then you could also kind of think about that maintenance credit on the back end, the property management credit, as paying yourself back for any points there. we are already accounting for maintenance and vacancy percentages in our returns.
Mhm.
So that it's kind of twofold. Do you want to keep that, right? You should have some reserves on hand anyway for your property. Do you want to add that to it and just be able to tap into that bucket
Yep.
as maintenance and vacancy arise? Or do you want to consider it a payback for a point buy down?
Buy down the rate. Yeah, I like that. I like that. You know, the more seeped I get into this industry, the more I realize that as a rental property investor, and Greg's been kind of telling me this for so long,
Yeah.
right? Like as a rental property investor, there is this kind of like psychological obstacle burden that comes with whenever there's maintenance. It's this is like high tension moment.
Yeah.
Right. It's just like this moment where you're just like, oh man, I gotta dip into into like my savings to pay for this thing. And is this really worth it? And blah, 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 blah. Whereas like in other asset classes, if your investment dips 15%, you don't even think about it because it doesn't actually touch your bank account. Right. So
Yeah,
like
it's not a conversation at the dinner table.
not a conversation at the dinner table. There's no one to question about it.
Yeah.
Right. So like I see this maintenance credit as one way to either hedge against that,
Yep.
right? Like say, oh, okay, so I'm actually not having to touch anything because I have this money already there.
Right.
No big deal. It was already set there. Or it's money to play a little bit of offense. Like if you can handle that kind of like that psychological hurdle and you're already prepped for it and you've already like put this money aside and you know it, you can then just use that money to increase your cash flow by lowering the rate.
Yep.
And that's kind of like a long-term investment
Right.
in future cash flow as well.
Absolutely.
Okay, cool. I'm into it. That being said, what are general kind of like cash flow conversations you're having right now? You were just telling me that people are coming in and you're not even listing year one cash flow on the property return. So talk to me how that kind of works.
Yeah, it's a pretty neat place to be now because clients are getting that. And that's nice. You know, of course, it's still a question. Like I said, we won't tiptoe around the topic.
Yeah.
But clients are really starting to understand now more and more so that, okay, there's a lot of those factors that are outside of JWB's control, right? So what is it actually going to look like for me in the long run, which is why we keep the focus there. So on our generator tool now, what we're highlighting is we're saying, hey, let's remember why we are getting into this in the first place.
Mhm.
What are these dollars meant to do for you the longer you hold on to it?
Mhm.
When do you really need them to start going to work for you? And based off of those answers is what kind of dictates how and when we get into the cash flow conversation. Because more often than not, it's folks that are saying, hey, I don't need them today. I'm willing to stay as close to break even as I can be,
Mhm.
which of course that's our goal too. And this maintenance credit on the back end,
Mhm.
our dollars back to you to absolutely make sure, you know, you'll have that in the beginning.
Mhm.
But then beyond that, let's focus and keep our time and attention and focus on what really matters as to what is this portfolio going to look like for you at the end of your holding period.
Mhm.
And anything beyond that, it's hard to say. You know,
Yeah.
it's really hard to pinpoint, oh, okay, well, as of year 3, expect this.
Mhm.
As of year 6, expect this. It's difficult to be that specific with it, but what we feel confident in is saying after a real estate cycle, expect this.
Mm.
So that's kind of why we made the shift that we did. And just getting that comfortability of saying everything I show you on my inventory is going to look the same, perform the same, based off of your capital and your entry point. What kind of dollars are we working with? And let that really also help us determine what makes the most sense for you from the down payment perspective, from a point buy down perspective, to really try to keep you as cash flow break even as we can.
Yeah. Okay.
With that maintenance credit on the back end, giving you some extra dollars to boost.
If I was to get really aggressive on this analogy that we've been making, the crock pot,
Oh, yeah.
right? It doesn't, you know, like if I was to think of cash flow, it's kind of like the servings of the meal to a certain extent,
Mhm.
right? And it's like if I'm putting something in the crock pot and I know it's got to cook for 8 hours, it really doesn't matter to me what it's going to taste like at hour 2 or 3.
Yeah, exactly.
Right? Because I'm not going to eat it at that
You
time.
may get salmonella.
You might get
Yeah.
salmonella. Yeah. That's it. We could go forever. Right. But when it comes to rental properties, we can peg it to like a full market cycle. And if you have a horizon of, hey, my kid goes to college in this many years, and at that point I need to have this much
Right.
to like play with in order to pay for that and the cash flow and blah, 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 we can we can set that, and we can set the hours of the crock pot to cook the meal for that point and
Yeah.
be real certain about it. So this is
Maybe
this
you need
is-
an Instant Pot, right?
Yeah,
Maybe,
yeah.
maybe it's a pressure cooker and we need to up our down payments, or we need to look at a
Yeah.
cash purchase, and we can do that. It's
Yeah.
just making sure that we are understanding on the front end the why,
Mhm.
and then building accordingly.
My mother-in-law just came in town yesterday, and she said she's buying us an air fryer.
Oh, that's great news.
I was super excited. Okay,
We use ours all the time.
so I got it. So cash flow today isn't really relevant. It's this idea of people are coming in with, this is my goal, help me build towards that goal. And that's what's really
Yeah.
clicking. And I want to talk about these other two. Were you about to say something?
Well, I was just gonna say, with the cash flow component, I think the big thing to come back to too is nobody wants you, and you definitely don't want to walk in thinking that you are in a liability.
Mhm.
And that, I think, is very, very important to differentiate of us saying, hey, let's not get so deep into the weeds on year 1, year 3 cash flow.
Yeah.
But at the same time, I also want to make sure that somebody doesn't feel like, okay, I'm getting into this and it's just gonna be a constant detractor of capital away from, my hard-earned savings elsewhere. So I think that that's a really important thing for everybody that comes to us to talk to us on the sales side to understand is we have built this, and it's why we structure, it's why we look at 30% down. It's why we look at, and we're getting the most accurate rates that we can, because we know that those things, we don't want this to be a liability for you either.
Yeah, makes sense. Makes sense. And that's kind of like that's the value prop of going to chatwithjwb.com, picking a time to like talk to the team, to talk to people like you who sees all this stuff and can take all the things in my shopping list and make the right crock pot recipe for you, right? Like
Exactly.
that's the value add.
Yeah.
So I think we talk about that all the time, the value of those first two calls of just like, hey, making sure that this is for you.
Yeah.
Right. And then, hey, let us show you how we build a plan to meet your goals, right? That's essentially the first two calls when you go to chat with JWB and you pick a time. So if anybody wants to do that, Jeremy, I know you're new, but it's always a good exercise. It's not you guys, like you just revealed your cards a second ago. Like you're not, even if an incentive is running out today, you're not going to try to get somebody, how can I get you in the house today?
No.
Like it's very much like a get to know you, and it's a really good exercise.
Yeah.
When I teach real estate stuff around the country, I always say, give JWB a call so that you can use that as the measuring stick to how everybody else treats you, right? Like once you see it, you can't unsee it, right? Like this idea of like aligning interests. All right, that being said, we're going to get into these two trends that I think are super, super relevant, but we have a couple of questions. Let's do that. Jeremy's got another question. Jeremy, he says, in general, what have the monthly rental rates been market-wise for the last 2 to 3 bedroom rentals? Also, how much gets pulled from your monthly management from that amount?
Great questions. I would say our average rent, and most of our properties are 2 or 3 bedrooms. Occasionally you'll get a 4-bedroom. Everything's single family that we're selling turnkey, sorry. But the average rent amount is about $14.50.
Yep.
So not much has changed there. From the management fees, so we're only collecting a monthly management fee if the home is rented. I always think that's important to note. And that's 10% of rent collected. So whatever that looks like for your monthly rent amounts, 10% of that comes back as our monthly management fee, unless you tier up into what we call JWB Elite, which once you reach 5 properties, that drops down to 9%, and 10 properties, it drops down to 8%.
We got a couple of JWB elites in the chat.
We
I
sure
see
do.
them. Tom Banzer's asking, he's got a property in Memphis that's going to be vacated at the end of January. What's the renter pool looking like currently? Tom, JWB really has like all the data in Jacksonville, right? Like the belief at JWB is to be fully vertically integrated, to fully own the outcome. You need to just be a mile deep and only an inch wide in just one market.
Yep.
So I don't think you have any stats on
I
Jacksonville.
could not off the top of my head.
Right.
Very good, solid.
But those were the stats on Jacksonville that you just shared. And then Anonymous Attendee asks, if I cannot find a property I like, can I buy one myself and get JWB to manage it?
The answer is yes, absolutely. We can very much serve anybody that owns a property that was not purchased by JWB and just would like for us to manage it. I would just make sure upon that process, right? Just ask yourself those questions of, okay, think like JWB thinks, right? In terms of the locations, is the demand there? Is there rental demand there? Maybe it is going to be a very low entry point. What are the dollars going to look like to do the renovations if those are needed? Will you be able to keep a resident in their long place? So just ask yourself some of those questions upon your acquisition strategy. And I think it's a great plan, and we can absolutely be here to serve you on the management side if that's the route you go.
Yeah, for me personally, right? I'm a customer of JWB's. I have my own business. I didn't want to spend time trying to find a property, trying to vet all these different things, bringing the property up to a certain standard. There's a great value, and I think the majority of folks here in this chat and in our community, they see the value in just this idea of, hey, JWB has this thing figured out.
Yeah.
Why would I try to like outsmart them
Yes.
in Jacksonville when they're the category leader and they figured all this stuff out, right? So like you can definitely do that, and folks have done that, bring property management properties to JWB. But if you don't already have it, like if you don't already own the property, it's probably not the best use of your time. Right. Unless you feel like calling in your brother-in-law and fixing a property for the next 3 months or whatever, right?
Yeah, absolutely.
So cool. All right. So this is to me the most interesting part of the call. As we were getting prepped for this, Kate, we found two fundamental changes that are happening as far as from the sales front of people coming in. The first that you told me is that folks are having post-COVID whiplash.
Yes.
What is that? Tell me what you mean by that.
So it's interesting. The folks that you look back at pandemic times, right? Rates being what they were, especially in Jacksonville, prices still very affordable. And you had a lot of new investors that were able to jump in, and they jumped in, was it feet first?
Head first.
Head
first. Yeah.
Okay. They jumped in head first.
Yeah.
And they were very, very excited, right? You were able to get very cheap debt. They were able to get these properties. Not so much time, energy, effort went into where are they and who is operating on my behalf.
The media, for like a blink of an eye, was like, everybody should be doing
Everybody
this.
do it.
Right.
Yes,
Yeah.
And they did, which, had a great impact on appreciation, right? You look at the impact that had on prices and demand and all these things. Well, what's now happening is you're a couple years into owning that property now, or those properties. You're a couple years into a relationship with that property manager. And there are quite a few folks that we are speaking to now that are saying, A, I'm getting what I paid for, or B, I wish I would have taken more time to get to know the company. The property itself is fine, but I can never talk to my property manager. I get crazy amount of work orders that I had no idea what this work was, when it was done, why it was done. I'm not communicated with. Nobody's there to give me updates.
Yeah.
The rents aren't increasing. The market isn't.
I bought in a market that seemed better than it is.
Right.
Yeah.
And so many folks right now that we're speaking to on the new business side of things are not brand new investors. They're new to JWB, but they are coming to us almost from a place of, I can't do that again.
Yeah.
I need to find a place that I feel really good about the operator.
That is so interesting to me because it's been recently that I finally figured out this idea that JWB serves not the first time. I mean, JWB is perfect for the first time investor. I'm a first time investor, right?
Sure.
Like, and for me, I don't know any different.
Yeah.
But it's almost even better for like the second time investor because you know the difference of what's out there. I think of Jag Chatta's story. I think of Leslie Wilson's story. So many stories we've had on the show of folks that are like, oh yeah, I really wanted to get into real estate. I got it. I realized that I didn't do all my, like I fell in love with like numbers on a sheet.
Yeah.
Or somebody told me that they were doing it, so I wanted to do it like them, and I fell in love with the person.
Yeah.
But I didn't really vet out this idea of, I only buy a property once, but somebody's gonna manage it for the life of that property. And if I can't count on that, that team,
right,
then none of this stuff is going to work for me because it's a lifestyle thing, much more than a, ROI thing.
Yeah, absolutely. And then that kind of comes back to the conversation earlier.
Yeah.
New construction versus renos, area of town. We could spend all the time in the world of saying, hey, let's just look at inventory, regardless of which property you choose. If your operator is not performing at a very high standard, it's going to eat away at your returns one way or the other.
Yeah.
And folks are feeling that. And even if it's not high maintenance numbers, just the lack of response and the lack of feeling like you are at least supported in this investment and you have some idea of how it's doing, good or bad.
Yeah.
That's what we hear the most as a big pain point for folks is just, I wish I could just talk to somebody about what's actually going on there.
I talk about this stuff all the time, right? Just recap here. There was a moment post-COVID where the media and everybody were just talking about single family rental
Yep.
properties. Wall Street rushed into it. A bunch of
Sure.
retail investors rushed into it like we did.
Yep.
And within all that, right, it's just kind of like when your friend tells you to buy NVIDIA stock, you're like, oh, okay.
Oh, yeah.
Right?
Yeah.
And you go and do it, right? And what we talk about a lot on this show is that the order of operations is broken.
Yep.
Most people, when they go into this asset class, they spend 95% of the time thinking about their property.
Mm-hmm.
Then, like the property is kind of like where the market is or whatever, just kind of like correlated to where somebody has like a lead on a property for you. And then they'll spend an hour, 2 hours on Craigslist and Zillow or whatever and Google looking for the best property manager
Yeah.
in town when, the order of operations should be find where the best teams are that can handle this for a passive investor.
Mm-hmm.
Then look at the different markets, right? That's the passive investor piece. The team piece is the who's going to give me visibility, who's going to give me the feel goods, that this like $300,000, $200,000 thing that I just bought is in good hands,
Right.
right?
Yeah.
Then there's the is this market going to perform the way I want it to, right? Like, sure,
Yep.
it sounds great to go buy a property in Cleveland or Detroit or whatever with like a bunch of cash flow, but are people moving there?
Right.
When somebody moves out, are you going to have somebody like right there to move in right after
Yeah.
it? Are rents going to continue to increase? Stuff
Right.
that's happening in Jacksonville because it's such a great market.
Yeah.
And then it's like, okay, once you have those two things, then you look at the property.
Exactly.
Right.
Yep.
So people getting got like that when like it got cool for a
Yes.
second makes perfect sense. And where I want to go with this is it's only going to get more important to have a great operator.
Sure.
Right. Like as we look at this like great generational wealth transfer, right? Like from boomers to millennials.
Yep.
Right. Like you're a millennial too, right? I'm a millennial.
Yeah.
We've greatly grown up with like access to information at our fingertips,
Right.
right? Like I was the last guy that had to look stuff up on an Encyclopedia Britannica, like like the ability, like the disconnect that's going to happen between folks being like, what's happening with
Yeah.
the property and actually getting like a response from them or not. Property managers are going to have to like keep up to that. They're going to
Sure.
have to invest in technology like y'all have
Yeah.
and have been doing really aggressively for 10 years.
Yeah.
They're going to have to invest in culture and recruiting folks to a team that didn't always see themselves as like, I'm going to be a property manager when I grow up, but do want to go work for a very high performing team with good
Right.
leadership and growth opportunities.
Yeah.
Right. So like, I just think that's just the tail of it. I would assume that this is going to happen more and more as people inherit portfolios and are like, well, I want to hold on to this, but what do I do?
Yeah.
Right. Like, I bet you that's going to continue to happen.
Oh, I think for sure. I mean, and just you look at the world changing and what technology is replacing, and you have to ask yourself, what do we not want to have replaced?
Yeah.
Right. And to have a team that this is home for us too.
Yeah.
So you talk about market changes. Well, that's impacting us personally as well.
Yeah.
You talk about downtown revitalization. That's impacting us personally as well. And so to just be able to know, hey, looking at market conditions, looking at what's happening right now in these locations, to have some trust in, okay, there is perspective, there is true ownership into what you all are saying because we ourselves are invested in this city. Like that you can't replace. That's not a chat GPT response that you'd be able to get.
Yeah, agreed. Okay, cool. So that's one big trend that's changed. It's like now more than ever, people that you're talking to are second-time investors
Don't want.
that got burnt, like in their second go around and trying to do it right this
Yeah.
time and 1031 exchanging or
Yes.
stuff like that.
Yeah,
right?
absolutely.
Yeah, so love that. Second is, and this one really puts a smile on my face, but you're telling me that Jacksonville is starting to sell itself now. What do you mean by that?
Yeah, it's really interesting. I look back 6 years. I'll be here 6 years in February, and I look back. My first role was setting sales calls. So I would get on the phone with folks and I would set our sales team for their first strategy call. And a lot of the questions that I got were like, I have never heard of Jacksonville. Where is it located? You are Disney World, right? And it is very neat to now kind of be at a point where we have folks that are saying, okay, well, your initial questions of how'd you hear about us? What brought you to JWB? The amount of folks that are so well versed now in Jacksonville as a city, it's extremely inspiring to know that other people are really starting to see the consistency that this market has offered. And not necessarily that, but the potential of like, wow, what an amazing opportunity that I could get into right now.
Yeah.
Because there will never be another right now in this city, right? You don't get to say, hey, downtown is already revitalized.
Go more into that. Go more into that, Kate. Are people coming with you with the story of downtown? Is
Oh
that
yeah,
what's going on? All right.
absolutely.
So like, go, like, we've got new people here. So
Yeah.
like, what is that story?
Yeah, I mean, just looking at like you're starting to see Forbes, right? You're starting to see fastest growing cities, best places to live in Florida, like all of these.
Second hottest job market in the U.S. according to the Wall Street Journal. Yeah.
Fastest growing population. You've got supernova city status, like all of these.
Fastest growing median income in Florida.
Like
Yeah.
those are headlines that people are seeing now. So what used to be conversations of us saying, hey, here's why this market has worked and will continue to work.
Yeah.
None of those things have gone away, right? We're still a very, very service driven economy here in Jacksonville. Those things are still needs.
Yeah. Still
Right, they
healthcare,
exist.
still finance, still logistics, still
Naval stations,
yeah, still
Amazon
government
stations,
and
the
logistics.
ports, right?
Yeah,
Like
yeah, yeah,
all
yeah,
of those
yeah,
things
yeah.
are still there. Plus, on top of that,
Yeah.
now you're getting some of these big headlines of saying Fortune 500 companies of
Yeah.
tech and health,
Yeah.
more and more healthcare and universities and all of these additional components that are really starting to recognize the opportunity in Jacksonville from an affordability standpoint, from a growth standpoint, to say, hey, we can plant some roots here. And that just continues. We talk about the flywheel.
Yeah.
Right. Now we've got more talent coming. Now we need more amenities for them. And so it just kind of ignites all of those components that we know need to happen for downtown to really take off.
Yeah.
Like they're starting.
Yeah.
And that's really, really cool.
Yeah. It is really cool. And this idea of, we talk about a lot on the show, right? This idea of, we know that when downtowns go from 8-hour downtown to a 16-hour downtown, which means people go from like just going to a downtown to like work and then leave, and then it's a ghost town, it's kind of dangerous afterwards, to people start to live, work, and play inside of a downtown, which has happened in Charlotte, in Austin, in Denver, and like all these, in Nashville, in all these great cities. We know that property values, the appreciation curve bends, and it just goes a completely different trajectory. And we've been predicting it on the show now for like as long as we kind of like started this conversation of tracking this and knowing that the tipping point is these like 10,000 units downtown, and the fact that that's already being built in the pipeline, projects already happening. We know we're going to get to 11,000 here within a year. And it's like buying into Apple right after they released the iPod, knowing that the iPhone and the iPad and all this other stuff is coming, right? Like, I think it's really cool. And it puts a big smile on my face, because I remember when we were first, you're about to be 6 years here, right? I'm like right at 5 years. But like when I first started talking to Gregg about the show, I was like, hey man, I think you got to talk about Jacksonville on your show.
That was a pillar.
Yeah, that's right. It was one of the core pillars of like, why Jacksonville, and the idea that it's really, really happening is like, it's incredible.
It is
I think
incredible.
It's really cool. Yeah.
And one of my favorite parts about our conversations with folks is like, you take all of that aside, and even without that, like, look at what we haven't had for this long,
And
it still worked.
Yeah.
Then you look at that, and like, that to me is that moment in time where people are seeing that now to say, oh, okay, you guys are now a name that are topping a lot of these big lists.
Yeah.
And it's only getting better.
Yeah.
So I think it's really neat to look at it from that perspective of, you take all of that away, it has still worked. You add that in, it's really neat to see what it's about to be.
It is really cool. And you know what, as we're going through this, right? Like, and I was just kind of railing on like the wrong order of operations, but I just realized that like the fact that people are now coming in because they've had a bad experience, so they realize the value of the team, and they're coming in because they realize the value of the market, it's finally actually the right order of operations. Right? Like, people really are looking for team first, market dynamics that provide, growth and risk mitigation at the same time. And what about property? Are people like getting hung up on property? Are people like asking more or less about that type of stuff?
You still get a ton of questions around it, and absolutely from the first time investor. A lot of time is spent there, as I think it should be, because we have to prove ourselves.
Yeah.
I can't tell you that my director of construction that just went to a trade show and came back with a knowledge of a Palisade tile, which is going to increase, the amount of moisture that a bathroom floor can take. Like, those are cool things that we get to experience.
Yeah.
But that doesn't mean a ton to a new investor that's
True.
like, oh, I don't quite know you yet. I don't quite know your product, your model. So yes, we spend quite a bit of time on properties themselves. But I will tell you, once you've looked at 2, you've looked at 12, because they all start to look the exact same. Returns are going to fall within the same bucket. Price points will be the exact same. Floor plans, finishes, color schemes, like locations, everything is
The
so,
widgetization of a
yes,
completely complex transaction is what you have
yes.
really figured out.
And it's been really neat because these folks that are not first-time investors, but
Yeah.
know what they want,
Yeah.
it's so much less about the property
Yeah.
because they yearn for that. Like, oh, you found out a way to rinse and repeat this thing and you've got 6 of the same thing. Give me all 6. Like, yes, sign me up. I want that. I want that repeatable product.
Yeah.
Not this, is this the one that's going to work or is this the one?
Yeah.
I've got one in this market. I've got one in this market, you know, like,
Yeah. 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 We talk about scalable all the time, but I think the magic word is repeatable.
yeah,
Right? Like if I'm going to dip my toe in real estate, most people are doing that because they have a why.
mm-hmm.
The why generally I was just talking to my best friend about this. He's like a hotshot lawyer, and he's like, "Oh yeah, I've got all these like venture capital investments and blah blah blah." I was like, "That's cool, dude. I want like 50% of my net worth to be in real estate." Like, and I want to get there,
Yeah.
right? Like I want the kind of like when I think about my 60/40 portfolio, I want the super low risk and
Yep.
pretty high return kind of like buoyancy of real estate to be at least 50% of my net worth. And if I'm going to do that, I can't just be like out evaluating deals left and right.
Right.
I need to be able to like have an assembly line that brings me this and it's at my schedule.
Yeah.
And I don't want it like, if I got to buy a property once a year, I don't want to spend 2 months every year trying to like figure that out.
Right.
I want to be able to just like put that like clockwork or if it's 2 years or whatever it is. Right. So,
I mean, and just from a business perspective, like
Yeah.
we need to be able to produce a type of inventory that we can replenish.
yeah.
Right?
Yeah.
If everything was this kind of one-off outlier, we would constantly be trying to fill that void and let's plug in this hole and let's plug that hole, right? Like we would constantly be doing that versus having such a repeatable product means we have enough ability to replenish that inventory as we need to.
I love that. And meet people's plans.
Right,
and
exactly.
do the thing, right? Justine Herrera is saying, I have 6 years residential property management experience. So important to have a solid team that communicates timely and consistently. The fact that JWB is so invested in everyone's success is crucial. Not Your Average Investor Show has continued to be so informative. Thank you. Thank you, Justine.
That's awesome,
pretty
Justine.
awesome. Anonymous attendee says, how big is the downtown and what is considered to be in downtown? I don't know how big the downtown is,
Yeah.
but I can tell you that downtown Jacksonville it's split by a river.
Mhm.
It's got the North Core and the South Core. The South Core is this like healthcare sector. And then the North Core, like right by the river, there's it's like a pencil thin mustache strip of buildings. And then above that, it's been decrepit for a long
Yeah.
time, right?
Yeah.
And what's really happening is that there is these big foundational like anchor projects that
Yeah.
are coming. One is the stadium and the stockyards and all this development that's being done by Shad Khan. It's going to include a Four Seasons and all these other things. And on the other corner is JWB has procured 20 city blocks of downtown. And out of the first 6 or 8 blocks is the Pearl Street district, right? You're already proving it out with this like first cluster that you have.
Yep.
Does that have a name?
Phase 1.
Yeah.
Pearl.
No, but before Pearl, it's like the Sweet Peas and, so there's like a cluster there that they've proved it out with. And then they just went really ham at this other part that it's essentially going to be like a 4 block by like 4 block full on citywide development with mixed use retail, hospitality, residences, like public spaces that's going to completely activate that area.
Our office.
Your office.
Yeah.
Your office is going to be there, right? So and once that happens, that's kind of like what a downtown. Well, when I say the 10,000 units, so first let's finish filling that in. When you want to fill in a downtown, you have to like build these clusters and then they end up connecting.
Yeah.
I lived through this in Miami, right? Like downtown Miami was dead. Brickell started happening, and then this area called Wynwood and the Design District started happening. And shortly thereafter, I just got back from Miami for Christmas.
Yeah.
It is just like, it looks like Manhattan forever and ever, right? Like, it's just like, it's completely filled in. So that's kind of like fundamental to it. But beyond it, the thing that starts the flywheel is the number that we talk about, 10,000 residents. When you want these units to happen, these mixed use developments to happen, retailers need to fill in like the bottom side of it, right? And there's like a cart before the horse thing of just like, are people going to be there to buy my stuff, or is stuff going to be there for people to buy?
Yes, they're the demand.
And once you so then that's when cities have to come in and provide incentives. Once you pass 10,000 residents in a downtown core, that stuff goes out the window. Now Whole Foods is like, yep, 10,000 people, I want to sell
Got
there.
it. Yep.
Publix wants to sell there, right? Like these anchor tenants that you want now want to build. So anonymous attendee, long story short is, I hope that answers your question, but it's like, it's a lot of these things coming together at the same time.
Yeah. I mean, in Jacksonville as a whole, right? Like we're the largest city by landmass in the contingent US. Like Jacksonville's huge. So downtown Jacksonville is also quite large, but it's kind of, I feel like, reflective of Jacksonville as a whole. Like you did a great job explaining it. You've got kind of these different pockets, right? These like neighborhoods within downtown itself. And the key to the success of the growth is connecting them all together.
You're doing fine with that. You're doing great with that. Correct. Connecting them all together. And I'll say this once, I'll say it again. I think what's really unique here is that most cities, or at least my lived experience of having seen this in Miami, right? People recognized it, and all these folks came in from everywhere and were like, how can I make a buck? What's beautiful here is that there is two very significant stakeholders that have been here, that are building for the long term. Shad Khan, who's been there since he brought the Jags, and all the stuff that he's done for the city has been phenomenal.
Yep.
And then now the idea that a developer of, you know, these like 4 partners that started when they were 24 and have grown up here doing this stuff and manage 6,000 single family homes all around the urban core realize I can bet much longer on downtown because everybody that I've been serving for the last 17 years gets to win. They get to build it the right way. And that is so, so unique, right?
Yeah.
Like, so it's really special to be a part of it. It's really cool.
It really is.
Cool. And I'm glad you're getting credit for that on sales calls.
It's about time.
Because it's not easy.
Yeah, it's neat.
Yeah, it's cool. All right, one more question. Joe Culler is asking, have you announced the registration for your tour at the end of February yet? No, Joe, we haven't said the registration just to save the date that it is going to be the last day. I think it's February 28th and March 1st. Right?
Yes.
It is those 2 days. So try to get here February 27th and stay through the weekend.
Yep.
It's going to be a lot of fun, but we will be announcing that here shortly. And Mike Foster also had some clarity. Plus the non-JW. All right. So this is when they were asking, can you buy your own property and bring it to Jackson to JWB? Mike Foster is clarifying because he's a fan of the show as well and a client that the property has to be in Jacksonville for JWB to take care of it.
Yeah.
Right?
Yep. It has to be in Jacksonville, and he is correct as well. We have minimum livability standards that we have to make sure our team's going to go walk it. It meets those standards for us to feel like we can manage it.
There you go. Mountain Man Billy Green says he just now noticed that you have champagne glasses on your sweater. I know. Kate had that. I'm like, oh my God, you have the great Happy New Year thing. And she's like, I also have hats and stuff. So she brought this stuff, and that distracted from your already festive attire.
I really knew today's my opportunity to go big on the show.
Kate, I don't know if anybody's ever told you this, but you have this like magical, effervescent like energy, like akin to like Buddy the Elf, but like not goofy, right?
Yeah.
Like, so it's awesome. Like you're always like festively attired and you're always like raising the energy of the room. I think it's really cool.
Make the most out of what you got.
Well, speaking of the most of what we've got, I think we've made the most out of 2024 today, Kate.
I know. I'm going to put you on the spot.
Oh, God.
Okay. Biggest accomplishment.
My biggest accomplishment in 2024.
You've accomplished a lot, and I've got to watch you.
Thank you.
Right.
I appreciate that.
Yeah.
Gosh, I honestly think that 2024 was the year that I truly became a leader and I embraced leading, you know, like having the foresight of setting an expectation for my company at the end of the year, traveling to the Philippines to meet my team and casting vision and getting their buy-in and making them believe that if they leveled up, the company will level up. And if the company levels up, it would make a material difference to their life. And then being able to deliver that on them. I just gifted them all new computers yesterday.
Oh my gosh.
Yeah.
Congrats.
So like being able to like deliver on all of that has really made me embrace leadership in a way that I never had. And I think that's my biggest accomplishment.
That's amazing.
Yeah. Thanks for asking.
Yeah.
How about you?
Biggest accomplishment, I would say, I mean, I have like personal, I have a 3-year-old and a 1.5-year-old and just this was a year of just kind of like building for us. Like, you know, I don't know, last year we welcomed my daughter. And so this year it's kind of like learning our new normal and like building some sort of consistency at home and like figuring out what life looks like with 2. And it's just so fun. Like I just got to experience the holidays with them and to see the holiday spirit in their eyes. You know, I get to live vicariously through them now. So that I would say is the biggest personal accomplishment. And then the sales side of this, like we haven't had very easy last 2 years from a market perspective.
True.
And to really be able to build a team here who is just so rallied around who we are as a company and what we do. And you kind of look at what we ask our sales folks to do, which is, hey, I need you to sell a home, but don't really sell the home. You know, like really learn our team and really, really sell that, because that's ultimately what matters. To have done that and to have a really great team of folks around me, and then I just get to celebrate and coach them. That's really neat.
That's not easy, and I agree. Like I've seen you grow as a leader and see you grow as a professional since I've been here, and it has been a tough 2 years of like from the greatest of times where
Right.
like people were like rushing in without knowing what they're
Yeah.
doing to like the hardest of time to sell the stuff
Yeah.
and maneuvering all that stuff, keeping the culture alive,
Yeah.
keeping the dream alive,
Keeping it
keep
alive,
selling the
baby.
dream.
That's right. Cheers and our champagne flutes. But I mean, that kind of like to end this out, right? Is now you've got folks that are coming in, clients that are coming in saying like, hey, I'm in on this Jacksonville thing.
Yeah.
I know what I need out of an operator. And then like we get to fill that love bucket so quick.
Yeah.
Like that is us. We've
That's
got
huge.
that.
That's
So
huge. That's huge.
It's
That's awesome.
exciting.
Well, here is to an awesome 2025 for both of us and for JWB and for the Not Your Average Investor community. I can't believe that we had 70 folks join us today.
That's amazing.
Right? Like we were like, is anybody even going to come to this 31st? And I was like, Greg, no one's going to come. But I was wrong, Greg. I was wrong. You were right, GC. You were right. You were right. So we can't, I can't, like, I love that I'm doing it with you, right? Because this community built from the ground up. And it just means so much to us that you spend, hours with us throughout the week, middle of the workday, on December 31st, getting ready for New Year's, and you're still here, still asking great questions, still being great. It's amazing. We never take it for granted.
Cheers to 2025.
Next week, we're diving into the top 5 predictions that Fannie Mae has put out in the real estate market. But from now till then, going into 2025, Kate, do you have any advice for people?
Don't be average.
Don't be average. Happy New Year.